All right, let's get right into it. This document set is dated January 30th, 2026, and right away we see this high-stakes conflict playing out. On one side, you've got this newly upgraded domestic growth engine really firing on all cylinders, but on the other, there's an explicit warning of a major external shock. That tension, that push and pull, is what we're going to track through one core theme today: exposure. And this isn't some abstract, theoretical risk. This is a direct quote from the economic survey. It puts the highest possible stakes right on the table. So it forces us to ask a really critical question. How resilient is the system really? And that's the strategic problem we have to unpack. And here it is, the whole conflict in one shot. On the left, that internal engine is revving up. Medium-term growth potential officially upgraded to 7%. But look at the right. That's a big red warning light. A severe external shock is on the horizon. This duality, this is our golden thread for this briefing: exposure. It's how India's growing connection to the world brings both incredible opportunity and, well, pretty significant vulnerability. Okay, so here's how we're going to break this down. First, we're going to do some deep dives on the three biggest stories. Then we'll look at the systemic shifts happening just below the surface and undercurrents. After that, we'll scan for early warnings and on the radar. And finally, we'll pull it all together in the synthesis. So, let's start with our deep dives. These are the three stories really defining the strategic environment right now. And the first one is the very document that frames this whole debate. So the economic survey is painting a pretty rosy picture of domestic health. You've got real GDP growth projected between 6.8 and 7.2% for FY27. That medium-term potential is now pegged at a solid 7%. And this is all backed up by some serious fiscal discipline. The deficit is set to fall to 4.4% of GDP. But here's the real takeaway. This new, higher baseline of confidence comes with a catch. It demands a mandatory stress test mindset, all thanks to that stark warning about an external shock. Let me give you an analogy. Think about it like a corporate forecast. The anchor is your company raising its annual sales target. That signals confidence, right? Everyone's feeling good. But the twist is that on the very same day, the board mandates a company-wide disaster recovery drill for a total system failure. One signals upside, but the other signals a known, high-impact threat you absolutely have to prepare for. That's the dynamic.
So what should you be watching? The documents point to three things. First, manufacturing output, to see if that growth engine is really holding up. Second, the fiscal and revenue data, to check the health of the government's financial buffers. And third, any real progress on deregulation. Bottom line, the official forecast is a clear dual mandate: plan for growth, but you have to brace for a significant shock.
Now we turn to our second deep dive, the landmark India-EU Free Trade Agreement. And the scale of this deal is massive. We're talking tariffs eliminated on about 96% of EU goods coming into India. And the EU is dropping duties on somewhere between 97 and 98% of Indian exports. The real prize here, the big strategic win, is a brand new structural channel for diversification. It's a vital escape hatch for exporters who are feeling the pressure from US tariff volatility. So here's how to think about this one. The anchor is like your company landing a massive, stable new client, the entire European Union. It's a huge win, diversifies your revenue away from a more volatile customer. But here's the twist. This new client has way higher, totally non-negotiable standards for quality and compliance. Getting access isn't automatic. You have to seriously level up your own operations to actually get the benefits. To stay ahead of this, you need to keep a close eye on three things: the actual ratification and implementation milestones, the detailed tariff schedules as they're released for each sector, and, this is the big one, those tricky compliance requirements for the EU market. Bottom line, the EU deal is a huge strategic opportunity, but its real value is completely gated by execution and compliance. Now we turn to our third deep dive, which is the intense pressure on India's currency and its capital markets. The rupee has slipped to around 92 to the dollar. And foreign investors? They're heading for the exits. They pulled out roughly $19 billion in 2025, and another $4 billion just in the first month of 2026. This creates two immediate risks. First, imported inflation, because things like energy get more expensive, and second, a much more volatile and uncertain funding environment for businesses. This next analogy really shows the power of these outside forces. The anchor is your company's stock price. It's that daily, visible number telling you how healthy you are. But here's the twist. the price isn't just about your performance. It's dropping because nervous global investors are selling off your entire sector. Not because of anything you did, but because of a wave of risk aversion. Your fundamentals might be solid, but you're getting dragged down by the tide. So, the key things to watch are pretty clear. Any sustained weakness in the rupee below that 92 mark, the data on foreign investment flows, and of course, any trade policy news out of the US that could rattle global markets even more. Bottom line, financial markets are the main pipeline for global risk to flow directly into the domestic economy. Now we turn to undercurrents. This is where we look past the daily news and explore those slower but incredibly powerful systemic shifts that are rewiring the whole system. Because, beyond the headlines, there are these fundamental shifts to watch. We're going to look at 4 of them: how the country is being funded, how inflation is being measured, the real-world paths of the energy and tech transition, and how the labor model itself is changing. All right, let's break these down one by one, looking at the driver, the exposure it creates, and what it means going forward. First up, the funding mix. The driver here is a huge jump in non-bank and foreign funding. What's the exposure? Well, it means a greater sensitivity to currency swings and global liquidity. The implication is pretty clear. Corporate funding models are just getting riskier. Second, the inflation signal. The consumer price index is being reset to a new base year with new weights. The exposure is that our whole sense of headline inflation is being altered. Food's weight is going down, transport is going up. The implication is that anything tied to CPI, like wage contracts or pricing strategies, needs a serious recalibration. Third, transition paths. The big drivers are the massive energy demands from AI data centers and the push for electric vehicles. The exposure is a new kind of bottleneck. It's not software anymore. It's physical stuff like power grids and copper. And finally, the labor model. The gig workforce has just exploded, up to 120 lakh people. The exposure there comes from really weak social safety nets. Low pay, challenges getting credit. The forward implication, you should expect to see rising policy and regulatory pressure for more worker protections. Bottom line, the fundamental wiring of the economy is changing, and that's altering risk profiles across funding, pricing, infrastructure, and labor. Now we turn to on the radar. This is where we look for those weak signals, those early warnings that aren't fully formed yet, but definitely deserve a spot on our strategic dashboard. The documents flag 2 faint signals to watch. First, there's an unpublished EV roadmap that could include much more aggressive adoption targets and maybe even penalties for fossil fuel vehicles. Second, there's a non-binding proposal for a one-stop hub to make it easier for Indian talent to move to Europe as part of that new trade deal. Now, the key thing to remember is that both of these are still just proposals. The operational details are still up in the air. Bottom line, these are early signs of policy direction for EVs and talent, but they are not yet set in stone. Now we turn to the synthesis. It's time to bring all these threads together, connect the dots, and really reassess the big picture. And this brings us right back to our central theme for today, the exposure equation. We need to be crystal clear on what has fundamentally changed in the economy and which risks are just sticking around. So what's new? Well, the documents show India's growth ceiling is now officially higher at 7%. Structural access to the giant EU market is basically secured, at least in principle. And funding channels are diversifying. That's all new. But what hasn't changed? A high sensitivity to external shocks, just like the economic survey warned. The currency is still a primary channel for imported inflation. And across the board, from the EU deal to domestic policy, execution and compliance remain the biggest hurdles. Which leaves us with one critical question that every leader needs to be thinking about. In this environment of both higher potential and heightened risk, is your strategy calibrated for that higher growth ceiling, or is it sufficiently braced for the coming shock? The answer to that question is likely going to define your performance in the year ahead.